Okay, welcome everyone. We'll start our lesson one. As a couple of you know me, my name is Anjum Sathar. If you have any question, please drop me email anjum@ukversity.co.uk. Before starting, we'll go through a bit what we're supposed to do. So this is a modules, uh, you can say specification, what we're supposed to go through. Okay, so key purpose really is to develop understanding about different reporting standard, and mostly we go through IAS's International Accounting Standard, which is set by International Accounting Standard Board. IFRS is called International Financial Reporting Standard, and please always good to be work towards distinction criteria. Uh, and the pass and merit, but always low AM is a crime, fail in life, no crime. So always AM high, always good to be. Okay, so understand the fundamental ethical, professional principle in relation to accounting standard and corporate reporting, which will go through, understand the appropriateness, financial reporting, which we'll discuss. Then each lesson will go through one LO, one learning outcome. So lesson one is learning outcome one, and then we have two assessment criteria, 1.1 and 1.2, because our assignment brief normally indicate and we deliver accordingly. That will help us when we'll prepare our assignment, our coursework. And then LO2, which we'll go through during our second lesson, understand the appropriateness of financial reporting framework. Then LO3, which we'll go through in our lesson 3, prepare the financial statement group of entities, which we'll go through, and lesson 4, which will be more about the financial statement, how we can interpret, we can draw the recommendation for the stakeholders, and we'll discuss the various stakeholders, and we'll go through financial ratios. We've been given these are all accounting standard. I'll give you and share with you ACCA F7 exam paper, which is called financial reporting. That will help you to be look around some standards, and I'll give you separate handouts for these standards as well. Okay, always good to be, if you really want to be up to date, always good to be registered. And I'll give you a few websites as well. So it's good to look around, because especially when you're working in accounts, so things are always changing, and will our CPDs will carry on. So this is the indicative content which will go through our lesson. Today our discussion will be focused on these key points. Then lesson 2. So these are our discussion will be divided accordingly. Maybe we'll not cover every single point, but overall our discussion will cover almost every point. But any particular point, if you think, which will go through as well. All these slides is available on our Moodle page, so please feel free. You can download from there. Some books are available, but because these are carry on changing every years. We'll try our best, to update, but some element of those change will carry on embedding our slides. So those will carry on going through. So LO1 is understand fundamental ethics. So we know ethics. Why ethics? Accountant always very ethical persons, yes? So like we'll go through a bit, abbreviation, popular people chat in office. Some people are very famous, they carry on chatting in office, so we can easily understand what those ethics are by abbreviation. So we'll go through standard corporate reporting. Anything really we learn, always good to be reflect, on scale 1 to 10, how much we know about accounting standards. Have we studied before? If not, we can go back to the basics. So, but yes, so what do you think? Where at the moment? We deal with the accounting standards. We prepare a statement accordingly. What do you think? Are you? Will carry on. It's good to be reflect. Huh? You can reflect your own, just for the sake of, and which will look here. Okay, that's indicative content which we'll go through. So first, explain the importance of professional behavior, compliance, accounting standards. So when we talking about accounting standard and professional behavior, we need to be focused on professional ethics. So hope you can see the slides. Please, if any question, you can stop me. PPCIO, easy to remember. It's called Popular People Chat in Office. So first P is a professional behavior. Second P is a professional. Yes, professional behavior mean not conflicting information, not biased. Yes, just be to be stick with your and not really uh, your the professional values not compromise. Huh? Professional competency and due care. Competencies and due care, which is meant by up-to-date knowledge. So that's why we need to do CPD every year. Because of course, tax rule every year, finance exchange. So we need to be every year we need to look from the basic. Yes, it's carry on. If you're a member of ACC or any other awarding body, yeah, you will be. So ultimately, we need to be look around these, professional code of ethics. Third, C is the confidentiality. Yes, so we need to be look around confidentiality. We need to be make sure we keep the client information confidential. Yes, we have various legislation. We used to be DPA 1998, General Data Protection, and then GDPR, General Data Protection Regulation being updated. Of course, electronic data as well, not just old. Yes, if someone want to get the information what we hold, they have a right through SAR by paying normally any company, whoever hold the data, we can pay £10, we can get it. Yes, PPIs work on the same rules. Yes, the clients they are getting and they keeping the fees. So confidentiality, we need to be make sure not pass the third party information to the third party. Only authorities by court if says in the best interest of the public, then we can disclose. Otherwise, we're not supposed to disclose. Third party. Okay, what is T? Integrity. Yes, always keep in mind integrity mean honesty. Yes, because a lot of things happen like Enron, World Telecom. Yes, World Telecom and various other issues happen like Trillion Construction Company, 175 million shortfall and various others. So it's a bit, that's why the new standard carry on coming to objectively. Your objective always true and fair information. Yes. Whatever, because we only can say, according to our best knowledge, organization is will be carry on business at least 12 months. The information we found and client gave us, that's our best our professional judgment is right or wrong. Yeah. And you can give, your assurance accordingly, but you can't give 100% guarantee because you don't know in and out, you rely on the figures, whoever. Okay, any question, please, if you have, you can. The main purpose of all these to ensure the transparency, reliability, and consistency and comparability of the financial. These are called qualitative characteristic of financial statement. So it's need to be transparent, reliable. So when we follow these ethics, we can provide the financial statement accordingly. Okay, they do by standardizing accounting policy. Yes, always good to be. You can do SOPs, your standardized operating procedures that always help organization. So everyone is well aware of. So when we're looking the professional and corporate ethics, we can look around the profession versus professionalism, always public interest, corporate ethics. Yes, ethics are the moral principle. It's not rule. It's come under civil. It can be penalties. We need to draw the safeguard, how we can protect, our, okay. Profession, the term professionalism can be explained as follows. Profession, anybody, a body of, the theory, the knowledge which is used to support the public interest. Professionalism is your, because your accounting is a profession, you're a member of your professional person, action to support the public interest. Yes, sometimes the conflict of interest come. Then we can think about, which one is, maybe some point I'll say, sorry, you can't say, you can't do the things because that's against your professionalism. Like, somebody saying manipulate this, or, oh, please just ignore the figures. We can rectify in the next VAT return and we can submit it. Yes, we can, but what is our ethics says? What is the public interest? Public interest pay the fair taxes, but maybe we holding it, and later dates we can rectify and we say, yes, it's been mistake. So there number of issues can be, because we can look around various scenarios, but we need to profession, we need to be look around how we can define, yes, best, protect. So that's a bit, these are the little mind maps, yes, keywords which will enhance, okay. So when we'll say professionally, when member are seen to be acting professionally, are literally having professionalism. Yes, when you're a member of ACCA or you're a member of any, yes, you need to be continuous maintain your CPD records, up to date your knowledge and skills, because it's carry on, because it's very difficult everything you do, but you try your best. Depend which area you really work a lot. So that can be, because otherwise there's a lot of rules, carry on changing. So we can look around accounting profession over the time. Yes, we can look around the profession appears to be taking more proactive than reactive approach. So taking the responsibility of negative consequences practice, yes, where they appropriate, amend those, practices to remove these consequences. So we can look around the best practices and we can carry on improving. I copied the link for you for further reading, always on the slide, which normally we using a lot of resources from Kaplan. Kaplan is a publisher. So if you're any particular ISs you want to explore, you can type IS like IS1 or things next to that if you write Kaplan. Okay, if you want to be registered yourself, it's a free. You can register on Open Tuition, which is set by London School of Business and Finance, and is absolutely free. And if you look F7 under ACCA, yeah, and if you want to explore it more, you can as well. Okay, so next our area of discussion, accounting standards, which we'll go through. Regulatory framework, yes. Why we need to these? Yes, we really want to make sure streamline the thing, will provide true and fair. We focus more on ISs instead of local standard FRS. Financial reporting standard, we moving towards international because the company have a more organized system throughout the world. One standard that will help people can easily understand, because the companies have global presence now. Yes, international financial reporting standards since 2005 onward, a lot of standards, yes, we have, because Enron, World Telecom, and various scandals and creative accountant, yes, these standards carry on coming. Yes, International Standard Board, then we have International Accounting Standard Committee, passed to board and then pass, these legislations really. So the conceptual framework set out the principle and the concept. International Accounting Standard Board believes should be analyzed preparation and presentation. A financial statement, we can look around what is the objective of financial statement? Always give the potential investors, stakeholders true and fair information. Yes, provide that will help them to make the right decision. Okay, so use a financial statement. We know, investors, lenders, and various stakeholders, they can use various purposes. But as accountant, we'll try our best to be provided. Yes, it can be help, the economic resources, claims, can be financial position of the company, financial performance of the company. Going concern, the business will carry on at least 12 months, not like Enron, when being, the given in the statements like the company will carry on as less at least 12, but after few months, they're not sustain in a business. So International Accounting Standard Board, fundamental quality of financial statement. Always we need to be make sure we include. Are we aware of materiality concept? Colin, what do you think? Are you okay for materiality?
Yeah, materiality concept. Yeah.
Okay, great. So that's about significance. Yes, all the relevant, all the significant information should be sometime if few bit and pieces you're not including or you miss, but that not influence on decision is fine. Faithful representation, we need to be make sure complete, neutral, and free from error information. Always, enhance, we need a comparability. Financial statement should be given 2 years so people can compare timeline, verify what we're saying, understandability in those have a basic accounting knowledge can understand those facts and figures. And we follow under which IAS we prepare? IAS 1, International Accounting Standard 1. That's about the preparation presentation about financial statement. IAS 7 is about cash flows. So which will go through different operating, financing, and investing activities. We have a IAS 16. No, we have a IFRS 16. International Financial Reporting Standard 16 about leases. That's in new. Yeah. So that's more about the presentation of lease, agreement into financial statement. Those have an extended period of because most of because those not used to show on this. That was the big issue in the past. But now we are showing these and we have to follow these, which we'll go through. Okay, materiality, which we earlier you already well aware of. Materiality mean all the we need to be make sure all the information should include international accounting standards we need to be follow. According to these standard, always you use your the when the people say asset, a resource control by company which will flow the future economics benefit. If anything not give you future economics benefit is not definition about asset anymore. Liability is a legal obligation. Yes, so we need these terminology. We should be and we need to be reflect. Those should treat as asset. We have a contingent is IES. We have various IES 36, IES 38, tangible, intangible, and contingent liabilities as well. So which we'll go through in. Okay, intangible. That's the asset which yes, intangible asset. We can't see it, but it's the asset. Yet don't have a physical substance. So we need to be recognized. We need to be reliable. We can when we'll say asset, sometime the definition, which thing we can also asset. Some can be contingent. It's not really the asset, but it will be asset if certain condition. So certain condition always is look around the future economics benefit. Like, if the GSK, GlaxoSmith clients, yes. So if making any formulas against our vaccine, but we need to, that's everything being passed research and development. So whatever research and development expense, we spend it and when we estimate it, but we need to be look around if we treat what we spend it and now formula is ready and we have a capacity to produce and get the economics benefit and we have all the resources expertise, then we can treat as an asset. Otherwise research and development expense not come under the is asset. So we need to look around the asset which will flow the future economics benefit. Okay, goodwill. Goodwill is come under IS 38, which is intangible. How we can measure the goodwill? That's other. Can we measure the goodwill?
Yeah, hello.
Goodwill is an asset. How we can measure it? How much worth of the goodwill? What do you think?
Come again with your question, please.
How we can measure the goodwill? Goodwill is the asset always we include in our financial statements, like financial position, which is balance sheet.
Yeah.
Yeah. So how we estimate how much is the worth of the goodwill we have?
I think the estimation of goodwill is, I don't know. I think it's based on the accountants. I don't know. That's what I can say.
No, that's fine. So let's see, we know accounting equations. Yes.
Yeah.
We have total assets equal to total liabilities plus our capital, we call
Capital.
equity. Yes. When we'll say total asset minus liabilities, yes.
Yeah.
If we'll take out, we get net asset, and net asset always equal to capital. Yes.
Yeah.
So let's say if your net asset is 100 million, it means your capital is 100 million. But if someone is happy to pay you 120 million, yeah,
Yeah.
why they paying you 20 million extras? Yeah, that 20 million they are paying you for the goodwill.
Okay.
Yeah, because otherwise we can look around, internally generating goodwill. It's because we can't measure reliably, we can't treat as asset. Yes, we need a professional judgment on it. Yes, because independent, because otherwise we can put it as much we want, and we can persuade our lenders, we have a goodwill of this million. That's other we have a problem.
Okay.
Okay, so research and development, IES 38 about standard, which says research is recognized as expense in the profit and loss, but the development, when it's reached that stage, this will flow the future economics benefit. So we have a technically feasibility, we have an intention to complete asset, we have ability to sell it the asset, we have an asset to generate a future economics benefit, we have ability of technical or all the resources to convert into medicine, that formula which we generate like GlaxoSmithKline, and then we need to be think about, then we can measure reliably, then we can treat it as an asset, the worth of what we spend it. Otherwise we not treat as an asset until we can measure reliably. That's the most important thing. Okay. Amortization, useful life of intangible asset can be net or in. Yes. So we need to be look around always. We need to be again use the, and otherwise we need to impairment. What is the impairment? Impairment is the loss. So impairment we need to be, and we need to do impairment review every year. Do we need to impair, which will go through separate impairment, IS as well. Okay, so impairment is the reduction of the recoverable amount of the asset below than the carrying value. So that's which we can look around. What is we can look around carrying value. So do we know what is a carrying value? One is called value in use, economics value, or we call real yes value. So we can look around, or you can say resaleable value. So these are all is, so what was the cost? So always you need to look around what is the carrying value. If the previous year depreciation, you minus it, so you will get the carrying value. If the carrying value is lower than the value in use and economics value, reliable value, so then we can do asset impairment, whichever is a higher. So value in use or resaleable value are, yes. So we need to be look around, and we need to do asset impairment. So that's which will carry out. Any question? So you've been given here carrying value out impairment review. So we can look around carrying value, recoverable amount. Yes, how much we can sell it, we can recover it. Fair value less the cost of disposal if we have, and then value in use. Whichever is a higher, you have to do asset impair accordingly. And we do impairment reviews. So if the carrying amount is greater than the recoverable amount, the asset is impaired. Yes, and carrying amount less recoverable amount, that's impairment is a loss. Yeah. So that's which we can look around. Okay, so accounting impairment losses, of course, we can reduce value of asset, revalued, and we can put the loss into profit and loss as expense for business, because that's depreciate, that's historically the value of the asset. Okay, inventories. What is the inventory? Inventory is a stock under IES 2. Inventory have three types. Inventory need to be value. Always inventory we do value, lower the cost and net realizable value. Yes, always we're looking all this accordingly. So you have to look around whichever is the lower. Yes, if the cost was the lower and your resale value is lower, no net realizable value, yes, which means what money you can get it. So you should do at the based on your asset. Maybe you bought 10 pound the things, you pay 10 pound and you record as an asset, but no, you can sell it only 5 pound each. So you should say asset value is 5 pound now, not 10 pound. Yes. So because that is a lower, so that's why it's always do the lower one. Okay. Yes, we used to do first in, first out, last in, first out, and all these are a value. But last in, first out method is the standard, not allowing us to do value of assets on based of the last in, first out. We can use for management accounting, but not financial accounting. Okay, then we have a IES 37. IES 37 is provisions and contingent. What is a contingent? Where have the maybe happen, maybe not? You have to make sure either you recognize in the book of account these assets are liabilities. You have to make sure, like the what are the chances if the probability of, like you have a case against in the court, if the probability of that is more than 50%, you can and we can measure it reliably how much will loss you can create it contingent liability. Otherwise we don't need to measure. Yes, provision best estimate and expenditure required to be settled the obligation. And so we should, because the main purpose of the financial statement true and fair only can be if we can put the right information about it. Contingent liabilities is a possible obligation that arise from the past events. Yes, again, the definition about liability. Contingent asset, yes, probably asset arise from the past event. Those existent confirm only the occurrence more than uncertain future. Yes, we have some. Yes, we can disclose, we can measure reliably. Then we can, what are the chances of happening, will be happen or not. So you have to use. Okay. Contingent asset, does the entity has the present obligation as a result of the past event? Yes. The outflow economics benefit possible? Yes. Can outflow be measured reliably? Yes. If yes, recognize the provision are disclosed as a contingent liability in the notes are the main. So now we need to be look around if yes, then or if not, is just disclose in the notes. Okay, and the likely you always check remote and any question? We all okay? Okay. Events after the reporting dates. This is IES 10. IES 10 is called adjusting events. Huh? So if the statements are signed off, then of course is you don't need to this year, you have to adjust it. But before sign off, then you can, that's adjusting events. Huh? condition existing reporting period, yes. Evidence of impairment, asset insolvency of customer, if that's yes. Adjust the financial. Non-adjusting events are indicated the condition. The after the reporting period, which is happened loss of asset due to the floods and other, that is not adjusting in this period. That's a non-adjusting for this period, but we can adjust in the next period. Okay, IS 18 is about revenue. Yes, so revenue, like, if you have a construction contract, what do you think? Yes. So what do you think? How we recognize in the book of account? Let's say you have a contract, even you receive a money advance. Can we recognize as a wholesale? Colin, what do you think?
No, not really.
So what we do then?
Well,
No,
when you when
just
you
an
re
argument. It's not a test, we're doing just a matter of,
yeah,
discussion.
are you saying when you receive a contractor amount from a
Let's say
contractor?
you have building the let's say BAM is a one of construction company. Yes.
Yeah,
So they build hospitals and government schools and things. Yes. So let's
yeah,
say they have a contract 5 million. Yes.
yeah,
And
yeah.
they advance receive, let's say 2 million before starting actual work.
Okay,
And they, let's say year end is 31st December. Yes.
yeah,
And their contracts start on the 1st December. 1st December, they receive the payment of 2 million.
yeah,
So what do you think, that 2 million will include this year's sales or not?
yeah. If it is received within the financial year, uh, the company's financial year, I think it needs to be recorded in the books
Okay,
of accounts.
no, because the rule says in the construction contract, what you need to do,
Yeah.
if you, let's say we started work 1st September until 31st, we receive only 10% work we complete, yes,
Okay.
of 2 million. So we only recognize of 2 million 10% of that, because you didn't work full. Yes, you start a job, yes, like
Yeah.
you building and you done the foundation of it, yeah, the work.
Yeah.
So what you can recognize only the net sales in the book of account is only 10% of that. Depends, yes, how many percent you work. You have to use the judgment. That 2 million you receive the advance payment, half of the construction, and half of the construction work, how much you done it. Yes. So you can proportion it. So that's
Okay.
other gray area accountant, yes, can creative. But the standard says we need a proportion it according to the complication complete work, yes, as a finished goods. Even you, because the money you receive it is a liability. If they can cancel the work, it's our money. So we do the cash debit, yes, as an asset when we receive it, and we can create a liability. Yes, it's not our money. Our money will become, liability will go down and the percentage become a sale. Yes, so we can do debit the liability because the liability will reduce. So we need adjustment really in these cases accordingly under IES 18. You got me? Any question?
No. So from what you said, if you receive part of the amount that you've charged or the amount of work you've done,
Let's say you receive 2.5 million, yes,
yeah.
out of half money, but you not done half work.
Okay. Okay.
You done one third, one fourth, one fifth, yes,
Yeah.
of the total. So one fifth or one third, whatever you completed, you can recognize as a sale.
Okay.
Yes.
Yeah.
Otherwise you manipulating sales. Yes.
Yeah.
Because you not provide the services. Services only the sale will be happen when you provide the services. Yes.
Okay.
because it's a like a prepaid, yes, prepaid income,
Prepaid, yeah.
because you're not done the work yet, yes, but you
Yeah.
receive the cash. Huh? Okay, then we have a ISR 16 property, plant, equipment, the treatments. Yes, we need to be look around and we need to be every year we need to do the depreciations. Yes, we need to recognize the asset value, future benefit, and we need to carry on doing the reviews. Huh? So we can do the cost model, what gain you have, what is the revaluation you have under IAS 16. Huh? International Accounting 16, the rule says we know the depreciation, we know the residual value, yes, is the scrappage value, and that's all we do under IS 16, International Accounting Standard 16. Okay.
Okay.
We disposal, yes, yes, we need to be recognized. We have a gain or loss on disposal, and we need to reflect according. So what we can do, we can prepare. Of course, we have a non-current asset registered separately, yes, and that's which we'll carry on doing, making adjustment, and the final figures we'll carry on putting in our financial position. Yes, like land, plant, and machinery. What we have, what addition we have, what disposal we have. Yes, what depreciation we have, what is the value at the end of the year, at the beginning of the year. Yeah. So that's which will carry on. That's NCA, non-current asset register, which will carry on, and will carry on updating. Okay. Then we have IS 7 international. Sorry, so many ISs, but we'll go through the basics. Yes, some International Accounting Standard 7, which about the cash flows. We know in the cash flows, if we look how many activities we have in cash flows. Cash flows.
No, carry on.
Cash flow statement are we called. Okay, first of all, I go in this way. Under IS 1, how many statement we prepare? One is called statement of comprehensive income. Under IS, we use the one word comprehensive income. Statement of comprehensive income. Okay. Second statement is also known as profit and loss. You call income statement. Yes. Second is a statement of financial position, which shows whole accounting equation, asset, liabilities, and capital. Yes. Statement of cash flow, and last is statement of change in equity. Equity means shares. Yes. So under IAS 7, we is the statement of cash flow, their preparation for separate. We have ISs. We have we have operating activities. If you want to see the cash, this is our normal business, which we do. That's our major business. Like Tesco, major business is consumer goods. Yes. Then investing activities, maybe you generate the cash under investing. If you have a spare cash, you invest somewhere, or you sold non-current asset, they increase and decrease during a year. That's the cash flows. And financing activities, yes, maybe your cash flows increase, decrease under financing, like you do equity finance, debt finance, your liability go down, cash position can go down. Yeah, your liabilities went up because you borrow more money. Maybe you can see easily the cash position, what's happened, is it went up, went down, under which section, and the final cash figure you always can find in the financial position. Any question?
Not at the moment.
Okay, we'll look some statements in later in following lesson when we'll do operating investing. We use two methods, direct, indirect. That's the different layouts slightly we follow. So here is uh indirect, which we normally use a lot. Yes, profit before tax. We get the figures from the statement of comprehensive income, we call income statement. Then we make adjustment, because here we preparing the cash. So because the depreciation is a non-cash expense, first place we minus it as expense in the profit and loss, but there is a no cash involved. Dividend received. Dividend received is not come under operating activities. It's come under investing activities. So that should go under. So each activity, the relevant, the things we always look around. What's happened in inventory last year, this year, this went up, went down. Uh, Trade receivable debtors figures went up, went down, because if went up, it's mean the cash position is went down, and when it's down, the cash position is up, so on. So we do plus minuses, and then we can say cash generated from operation. We look interest paid if we have, tax paid we have, and direct method is look like, cash received from customers, suppliers, and cash generated. Everything we can do plus minus here, and we can put it the net figure there. Any question if you have, you can carry on asking, please. And the statement of the cash flow is look like, yes, operating activities, investing activities, and financing activities. So we can look around. These are some elements which will carry on looking the changes in 2 years, and then we can make adjustment, and we can say this is our cash flow statement. Okay. We've been explained what is meant by cash generated through operation, interest and tax we minus, yes, investment activities, what's happened non-current asset buy sells during the year invest. So their position will carry on, we say increase or decrease the cash, and financing we're looking non-current liability, what's happened, we can look around what's happened under the our shares is went up, went down, and we look, the cash increase and decrease at the start of the year balances we include, and then we find what is the net balance at the end of the year. Okay, we already discussed about ethics, integrity, objectivities, corporate reporting. We need to be 1.2 ethical requirement we need to be follow, and we need to be focused on 5 professional code of ethic, which is given by International Federation of Accountant. If you're a member of ACCA, ATHE, and various other boarding body, most of them follow these, and these are all ethics is the principle based approach, not rule based. Rule is based mean by law, like GDPR 2018 is the law, not it's a rule. Yes, it's not a principle. Principle is more about, okay, always you use your ethical principle, self-interest. If you're recommending somebody to do, and maybe your back end, you have an investment in that company, self-review, checking your own work, advocacy. If you have two clients, you give advice how you protect the interest of both. Familiarities, if you're too familiar, many is you doing, maybe they offer you gifts and things, and then please you draw the safeguard, because otherwise intimidate, if you don't do it, will be everyone risk, you lose the commission, you lose the job. That's a intimidate you, and we not accept the intimidations. Entry requirement, training requirement, you need to be safeguard, safe practice in business, which we need to be already draw. If you're working in account practice, are you member, are you working for someone else? Reliability of information, credibility and the value for audit, and credibility of profession, not compromise. And we need other, the whistleblower concept we need to be keep in mind. Ethic principle, we need to be look around the, yes, close business relationship, self-interest, your retirement, financial, maybe you're getting free holidays from the client, because that's, self-interest, maybe self-interest influence on your objectivity. Your objectivity may be compromise, you not give true and fair information to user. Self-review, if you're checking your, maybe you used to work in bookkeeping and department accounts, and now you're doing an audit, it's mean, you checking your own work, we not supposed to be do these. Advocacy, if you have two clients come to you and they have a merger and acquisition, and if you give advice to one and you compromise, so how you draw, so you can maybe give one to other client, other you not deal with the both, because of how you protect your objectivity and professional behavior. Conflicting interest, maybe your own interest there and your family relationship, like, if you don't do the accounts, and that's, really is all about. Okay, any question?
Um, not at the moment. With the advocacy threats,
Yes, advocacy normally when it's come two clients, yes. Let's say client A and B comes to you and you have to give the advice. Both are your client, but they are competing each other and both want advice from you. If you're giving advice to one, maybe you compromise the interest of others and so on. So you
So,
have to draw the safeguard.
so in this case, what do? Both are your clients and both are competitors, and they want a financial advice. What do you do? Do you have to go ahead
If
and advise both?
it's the best you draw the standard procedure. You don't give the advice to one. You can recommend to your other client, yes, but without telling them, because if you tell, then maybe you're compromising your confidentiality as well.
Oh, so if you face
Because maybe they shouldn't be aware of you giving advice to both.
oh,
If
so
you're telling, oh, my other client is the client and you're doing the contract each other, I'm not giving. That's it. Confidentiality can be broken.
so in this case, when they come to you, do you have to tell them that um
Oh,
because they are,
my other colleague will give you advice. I can't. Yeah.
no, I'm confused. What I'm trying to say is if both are your clients
Hmm.
and they are competing for a particular contract and then they want advice from you, can you advise one and give one to your friend, one of your clients to another friend?
Yes,
Or
without mentioning it. Yes.
okay, okay.
Because if you say, because I can't give you advice because you're competing both or you're both my clients, it means you're breaking the confidentiality.
Okay, okay.
So other is also come under this is contingent fees. If I'll say I'll save you £10,000 tax, I'll take you £3,000 fees. Can I take it?
Okay.
What do you think? Let's say your clients come to you and
Yeah.
say, if you save me tax 5,000, yes, HMRC send me £10,000 tax. If you save me 5,000, half I will give you.
No, to me, if you do that, you've compromised and you have not been um, professional in the discharge of your duties.
You're
So,
right. Because
uh,
we can't charge the contingent fees, the link with the tax. Yes. We can only charge our, if you say no problem, I charge £3,000 an hour. You can charge £3,000 an hour, but you can't link with the tax. If you save it, then you will pay me. Yes. Because you're giving your professional advice. Yes. How much credible and the knowledge you have, you can charge the fees. But you can't link it. If you save tax, you pay me half of it and that. This can't be linked.
okay.
Yes.
So in this case, what ethical principle applies to that?
Because it's going to compromise your objectivity.
This is objectivity. Okay, fine.
Yes. And it's not, it's a professional behavior. We give that advice to somebody in
Okay,
unprofessionally. Yeah.
okay.
Okay. Yes, these are, there can be number of scenario. Yes, like your client money you can't put in your, or you can buy properties from their money. Yes, that's, also is. Okay, so today we learn about more about accounting standards. We went through the statements, we look and various standards, IS1, IS2, IS7, IS16, IS 10, IS 38, IS 36, IS 30, IS 7 we went through. Yes, these are the key standards. And we discuss about ethics and how we can protect, our ethical values. And that's all was, and we said, ethics is come under the uh, principle, not the rules. And thanks for attending today's session. Please, all this recording will be available. All previous recording also available on Moodle. So if you have any question before next lesson, you can drop me email. Please, it's good to go through these standards and look around and explore. That will help in our profession. And I will see you next week then. Thank you.